Hey folks, welcome to a product review at Finominal. Today we're going to look at real estate investment trusts, which are also known as REITs. And we're going to use a product from Vanguard, the Vanguard Real Estate Index Fund, as a proxy, simply because it tracks the MSCI Real Estate Index very closely, which is a benchmark index for REITs in the US. Now, the Vanguard product, which has the ticker VNQ, has around $30 billion of asset under management. It charges 12 basis points, so it's very cheap, and has a track record more than 20 years. Now, what we're specifically interested in is exploring if REITs diversify, because the primary reasons why REITs are bought are for yield and for diversification, which is something frequently used by companies marketing REIT mutual funds or ETFs. So let's get into that. And we're going to start with a simple performance benchmarking exercise. Now, as mentioned, VNQ tracks the MSCI Real Estate Index fairly closely. So you can see there's almost no differentiation between VNQ and the index. And you can also see the performance since 2014. So we have about 10 years of data compared to the S&P 500. Now, what we do see is pretty much consistent underperformance of REITs versus the general stock market. Now, if you want to look at in terms of what's driving the risk and return of REITs, so over here we can see the factor betas to four major asset classes, and we can see that the exposure to the stock market, as represented by the S&P 500, is pretty much, well, it's consistently positive, of course, right? So the stock market is one of the key drivers of risk, but you also see that there has been exposure to bonds over time. Now, intuitively, bonds and real estate are related because investors tend to buy both for yield, and REITs are also leveraged, so they also benefit, like bonds, from decreasing interest rates. Now, and during the last, let's say, 15 years or so, right, interest rates have mostly declined, except for the last couple of years. Now, the interesting part is that the beta to bonds has not been consistently positive, right? It has also been negative. So that's something interesting to think about. From an equity factor perspective, we do see that there's consistent exposure to the size factor, to low volatility, and consistently negative exposure to value and quality. And that kind of makes sense because REITs tend to be smaller companies. They tend to be less volatile than the average stock and stock market, but they also tend to be expensive on a price to book and PE perspective, and relatively low quality because most REITs are highly levered. Now, that's in terms of from a factor exposure, right? From an asset class as well as equity factor perspective. Now, a lot of investors associate real estate and from there on also REITs with providing lower risk and perhaps protecting your portfolio, protecting capital in periods of market downturns or market crashes. So let's have a look at the drawdown profile of REITs. And we can see over here the kind of like rolling drawdowns since 2005. So we have 20 years of data of VNQ versus S&P 500. Having said that, what we do see is, right, that during the GFC in 2009, VNQ had a drawdown of, I think, 72% versus 50% of S&P 500. And of course, also real estate was in the center of the global financial crisis, right? So perhaps that you could kind of excuse that the drawdown was larger and REITs did not protect your capital more than equities. But also thereafter, right? In pretty much all the periods, right? COVID, right? And 2022, REITs did worse from a drawdown perspective than the average stock. So it's kind of interesting to think about. And then in terms of diversification, right? So that kind of like is the next topic, right? So we already know that REITs have not been less risky, right, than stocks, but we can also see they're highly correlated. So the last 20 years, the correlation to S&P 500 was 0.75. Now, that measure implies that the diversification benefits are limited, because if you're too highly correlated stocks, right, then you can't provide proper diversification benefits compared to truly alternative strategies. And we can quantify that, right, by running a very simple simulation where you simply compare a portfolio of 100% equities, which is this, 100% allocated to the S&P 500, which would have generated a Sharpe ratio of 0.57 over the last 20 years. If you would have allocated 25% to REITs over the same time period, our Sharpe ratio would have decreased to 0.51. So stated differently, they did not offer any diversification benefits. And so that kind of concludes our short review of REITs, because there's, frankly speaking, not much more to say, in the sense that often REITs are perceived as providing diversification benefits because they kind of like seem like real estate, right? But practically speaking, they trade like stocks, right? We've seen from a drawdown perspective over the last 20 years, right? The drawdowns were either similar or worse to the general stock market. So there's still, of course, the argument of allocating to REITs for yield. But as we often have pointed out, it makes no sense to sacrifice the return of capital for the return on capital. And so I hope that helps. Have a nice day.